Investment is a game of informed decisions and timing. You can create wealth if you have the necessary information and invest at the right time. But making smart investment choices is easier said than done. Market volatility and unpredictable events can make even the most lucrative investments fall flat. This video will outline 6 major types of outperforming investments, what the strengths and weaknesses are that can be capitalized on at certain points in a business cycle, and how to put them together into a wealth-building strategy. Hey guys! Hello and welcome back to another amazing video. If you want to see more enthralling content like this, please like, share, and subscribe to our channel. Let's get started. Number 1. Equity index funds and ETFs. Index funds are investment vehicles that track major market indices like the S&P 500. Rather than trying to outperform, they merely match the market, but they do so at such low costs that they end up outperforming most actively managed investment funds that charge high fees for lackluster performance. Usually, you'll want to hold some stock index funds, some bond index funds, some international stocks including emerging markets, and maybe some alternative holdings like REITs, precious metals, and other asset classes. The key is that you need to rebalance your index investments at least once per year or use a service that automatically rebalances it for you. Historically, over long periods, equity index funds vastly outperform bonds, so it's important to have a large exposure to them during most stages of your life. Number 2. Dividend growth investing. Passive investing via index funds is becoming more and more popular and outperforms active management in most cases. However, there are still some areas where index funds do not perform well or do not meet the needs of all investors. One of the biggest examples is in the specialization of dividend growth investing. Many companies in the United States have not only paid dividends reliably, but have grown their dividends every year without fail for decades. Companies like Dover Corporation, Emerson Electric, and Johnson, Realty Income, and dozens of others have incredibly long stretches of consecutive annual dividend growth. In other words, even during recessions or when the stock market goes down, they keep increasing their dividends to shareholders. This is particularly important if you're trying to live off of your investment income. For example, during the 2008 financial crisis, the S&P 500 dropped over 41% from year-end 2006 to year-end 2008, but annual dividend income only dropped 21%. When you invest in index funds, the common rule is to withdraw up to 4% per year so that you'll never run out of money. The problem is that the stock market can go up and down severely, so if you're restricted to a certain percentage to withdraw, it means your investment income will fluctuate with the stock market. This year, you might have $20,000 in investment income, while next year, you might only have $15,000. If you withdraw more than 3 to 4%, you risk reducing your principal. Even dividend-focused index funds haven't been able to fully solve that. They're great investments for overall growth, but they're still not ideal for producing reliable growing investment income. Just about any dividend index fund or ETF you look at, whether it's the Vanguard High Yield, Vanguard Dividend Appreciation, or anything else, you'll find that in some years, the dividends go up, and in some years, they go down a bit. They're unreliable because they don't have robust dividend stock selection criteria. An investment strategy of using actively managed do-it-yourself dividend growth investing can fix that as long as you select a balanced portfolio of the right companies. Number 3. Selling options for growth and income. Selling covered calls and cash-secured puts is a great way to boost your income and reduce your volatility. Unfortunately, investing with options is an investment strategy that many people assume is risky or time-intensive. While that's true in some cases, the reality is that options give you more flexibility than just about any other investment. You can use them to increase the potential for risk and returns, but you can also use them to decrease risk and produce cash flow, which is what I do. I make thousands of dollars of investment income per year by selling covered calls and cash-secured put options while reducing my exposure to market corrections at the same time. When you sell a put option, you take on the obligation to potentially buy a stock at a certain price before a certain date. And when you sell a call option, you take on the obligation to potentially sell a stock at a certain price before a certain date. In exchange for taking on these obligations, you get paid an option premium up front by the option buyer. In other words, if you're interested in buying the stock of a great company, but would prefer to wait for a lower price, you can sell a cash-secured put option to get paid to wait until the stock dips to the price you want, and then automatically buy it. Number 4. Real estate investing. One of the oldest and most reliable smart investment strategies is to build a portfolio of high-quality real estate. The reason it's so powerful is that it can be leveraged rather heavily. For a relatively small amount of capital, you can control and profit from a large amount of real estate because you can finance 70 to 90% of the cost. Number 5. Alternate investments. Some investments exist outside of the scope of other, more common investment strategies. An obvious example through the ages is to invest in precious metals, either physically or with an ETF. Master Limited Partnerships, MLPs, may be considered a form of alternative investment. With them, you get to invest in pipeline companies and other natural resource businesses. A more recent opportunity is to invest in peer-to-peer lending to produce reliable cash flow from a diversified portfolio of personal loans. An example of an alternative strategy I'm using is that I generate income from selling put and call options on gold and silver ETFs. In the current environment of very low interest rates, I prefer this investment strategy compared to holding bonds in some of my accounts. There is no limit to the types of investments you can make. Some people can make a ton of money from coin collecting or even buying and selling luxury watches in their spare time. You could buy a website and hold onto it for cash flow or to sell it at a higher price later. Some of these can be really skill-based and give you a competitive advantage for high returns. Number 6. Entrepreneurship. The other 5 investment strategies on this list require upfront capital and are great for turning money into more money. But if you want to accelerate your wealth accumulation, you can also trade time to build a business, which you can then hold onto for cash flow or sell for a big capital gain. Depending on the business, you can also put a lot of capital in to get an amazing rate of return over a fairly short period. In my senior year of college, I started a small online business, which eventually brought in a meaningful amount of passive income and which I eventually sold to another company when I was 26. It wasn't a ton of money, but it gave me a boost to pay off my student loans and increase my savings on top of my engineer's salary. More importantly, I was able to serve over 1,000 customers and learn valuable skills that I'll have for the rest of my life. I'm a big proponent of small businesses and side gigs. In this increasingly globalized world, it pays to be diversified and to have streams of income that you control. And it's such a valuable project to take on in terms of personal development. That's all for today. Thank you for taking the time to watch the video, and remember, don't forget to subscribe to our channel for more.